Something is happening in the housing market. Pay attention. This isn't just a small correction or a temporary slowdown. The warning signs feel eerily familiar. They remind me of the rumblings we ignored in early 2008, right before the big one hit. Now, let me be clear. I'm not saying this will be an exact replay of the GFC. The banking system is stronger. Household balance sheets started from a better place, but the underlying mechanics, the human behaviors, and the risky patterns are rhyming. When history rhymes, smart investors listen. This slowdown is not random. It's the predictable result of forces building under the surface. It's about easy money drying up. It's about affordability stretching to the breaking point. It's about the return of risky lending practices. A slow-motion pileup of risks is forming, risks that could damage your portfolio. Ignoring these signals is a mistake. Saying, "This time is different," without hard evidence is a recipe for disaster. Be a student of the market, not a cheerleader. The signals are flashing red. They're coming from multiple directions at once. You have rising delinquencies. You have the return of risky loan products. You have other household debt, credit cards, and auto loans also flashing warning signs. One or two of these? Noise. All of them together? A signal. A loud one. The time for complacency is over. For you, the investor, be smarter, be more disciplined, look past national headlines, dig into the details. Understand not all real estate is created equal. The game has changed. The easy gains are gone. From here on, manage risk. Don't just chase returns. Know what you own and why. Be prepared for turbulence that could last longer than many expect. Let's talk about the fuel for the fire. It's always about the lending. After 2008, we got serious for a while. Banks tightened up. Underwriting standards meant you actually had to prove you could pay back the loan. Risky mortgage products that blew up the system were put on the shelf. But memories are short in this business. The pressure to make deals and the desperation of buyers priced out of the market have brought back some old bad habits. We are seeing a significant and worrisome return of adjustable rate mortgages, or ARMs. These are the same loans that were at the heart of the 2008 crisis. An ARM looks great on paper at first. It offers a lower initial teaser interest rate, which means a lower monthly payment. This helps more people qualify for a mortgage they otherwise couldn't afford. But that's the trap. The rate is not fixed. After a few years, it adjusts based on the prevailing market rates. If rates go up, that monthly payment can skyrocket. The share of home buyers using ARMs has more than tripled in the last 5 years. In 1 week last September, ARMs accounted for nearly 13% of all mortgage applications. That's the highest level we've seen since 2008. Why is this happening? It's simple. It's a response to pressure. Fixed mortgage rates got too high for the average buyer, so instead of prices coming down to meet reality, lenders and buyers found a workaround. They reached for risk. They chose a product that prioritizes short-term affordability. This is not a sign of a healthy, sustainable market. It's a sign of a market under extreme stress, where participants are making dangerous trade-offs just to get a deal done. It's a classic late-cycle behavior that almost always ends badly for someone. This shift toward riskier lending is a huge red flag because it plants a time bomb inside the housing market. Millions of recent home buyers are now sitting on mortgages with adjustable payments. If interest rates stay high or go higher in the next few years, when their teaser rates expire, they will face a sudden and severe payment shock. This is exactly the scenario that led to the wave of defaults and foreclosures that triggered the last crisis. We are willingly repeating a key mistake, and that should make every investor pause and think very, very carefully about their exposure. Just as risky products are making a comeback, the rules designed to protect us are getting weaker. After the 2008 meltdown, regulators put up some important guardrails. They created rules like the ability to repay standard, which forced lenders to verify that a borrower had the financial means to handle their mortgage payments. These weren't perfect, but they were a necessary break on the reckless lending that had become common. Now, we are hearing more and more talk about rolling back some of these protections. The argument is always the same. The rules are too strict and they are hurting affordability. This is a dangerous and misguided argument. It confuses access with success. Giving someone a loan they cannot realistically afford isn't helping them. It's setting them up for failure, foreclosure, and financial ruin. Weakening borrower protections in the name of making housing more affordable is like trying to make a car cheaper by removing the seatbelt's airbags. It might lower the sticker price, but it dramatically increases the risk of a catastrophic outcome. When you lower underwriting standards, you are not creating sustainable homeownership. You are just pulling future defaults into the present. The pressure to deregulate is powerful. It comes from lenders who want to make more loans. It comes from builders who want to sell more houses. It comes from politicians who want to claim they are solving the housing crisis. But loosening the rules right now, at a time when the market is already showing signs of stress, is like throwing gasoline on a smoldering fire. It ignores the painful lessons that we should have learned just over a decade ago. The guardrails were put there for a reason. They were built on the wreckage of the last crisis. Tearing them down is an act of historical amnesia. For investors, this trend is a major concern. If regulatory oversight weakens, the quality of the loans being originated will decline. That means that the mortgage-backed securities that these loans are packaged into will become riskier. It will become harder to trust the ratings on these securities. It will require you to do more of your own homework to understand the true credit risk you are taking on. A weaker regulatory environment means more hidden risks and a greater chance of being surprised by a sudden wave of defaults from loans that should never have been made in the first place. Let's talk about the elephant in the room. That's the role of the government. Fannie Mae, Freddie Mac, FHA. They don't make the loans themselves. They buy them from lenders. They package them into securities. They guarantee payments to investors. That provides the liquidity that keeps the system running. Their footprint has become massive. As they absorb much of the market, they absorb a tremendous amount of risk. This creates a serious problem. It distorts the market's price discovery mechanism. In a free market, investors demand higher return for riskier loans. Higher cost would discourage the riskiest lending. But government guarantees mute that risk-based pricing. The backstop acts like a giant insurance policy. That encourages lenders to make loans they might otherwise avoid. Lenders can sell them off and transfer the ultimate risk. This keeps the party going, but hides the true cost. The system appears safer than it actually is. Private capital gets crowded out. Risk concentrates on the public balance sheet. Ultimately, the risk falls on you, the taxpayer. If a wave of defaults occurs, agencies would cover the losses. This is a moral hazard of epic proportions. It privatizes profits from lending. It socializes the losses. For an investor, be extra skeptical. MBS yields may not reflect underlying credit risk because of guarantees. You might think it's a safe government-backed asset, but you're still exposed to the housing market's health. If home prices fall, guarantees can come under strain. Political environment becomes a major risk factor. You're not just investing in mortgages, you're investing in political stability. Now for the hard data, this isn't about feelings or anecdotes. This is about the numbers, and the numbers are telling a story of growing stress. According to the Mortgage Bankers Association, the delinquency rate for mortgage loans on residential properties is on the rise. At the end of the third quarter of 2025, it climbed to a seasonally adjusted rate of 3.99%. That's up from the previous quarter and up from the year before. This shows that a growing number of American families are struggling to make their monthly house payments on time. It's a small increase, but the direction of the trend is what matters. Digging deeper, the picture gets more concerning. The increase is being led by worsening performance in FHA loans, which are often used by first-time homebuyers and those with lower credit scores. The seriously delinquent rate for FHA loans has jumped by almost 50 basis points over the past year. Seriously delinquent means the borrower is 90 days or more past due or is already in foreclosure. This is the last stop before the borrower loses their home. Data from Totality shows that the overall share of loans that are seriously delinquent is ticking up. And more importantly, borrowers who fall behind are finding it harder to catch up. This isn't just about one or two missed payments. We are seeing a clear progression into later stages of delinquency. According to some reports, the share of loans that are showing increasing foreclosure rates has jumped from just 8% to 39% in a very short period. This is a leading indicator. Foreclosures take time to work their way through the legal system, but the pipeline is filling up. This trend is particularly pronounced in lower-income areas. The New York Fed found that for borrowers in the lowest income zip codes, the 90-plus day delinquency rate has surged from around 0.5% in 2021 to nearly 3.0% by late 2025. What does this all mean? It means the foundation is cracking. While the overall delinquency numbers are still below the catastrophic levels of 2009, they are no longer at historical lows. They are steadily, undeniably, getting worse. The upward trend is a clear signal that the financial cushion that households built up during the pandemic is wearing thin. Rising inflation, higher interest rates, a slowing economy. For investors in mortgages or real estate, rising delinquencies are the canary in the coal mine. They are the first direct evidence of financial distress that eventually leads to losses. You have to understand that the U.S. housing market doesn't exist. There is no single market. There are hundreds of local and regional markets, and right now they're telling very different stories. Some areas still show strength. Others are in significant distress. This regional divergence is critical. National averages hide pockets of real trouble, and those pockets are where a wider crisis could begin. Pay attention to local data. That's where the truth is. Let's look at the states: Arizona, Louisiana, Indiana, Iowa, Texas. These aren't the usual suspects. Stress is spreading to new areas. Gulf Coast states have long had higher delinquency rates. Now sharp increases are in the Southwest and the Midwest. The geographic spread shows the problem isn't isolated. It's becoming a national issue. Even if severity differs by place, city-level data can be even starker. Take Laredo, Texas. According to one report, as of mid-2025, around 24% of mortgages in that city were in some state of delinquency. That is a stunning number. Local economy and housing market under extreme duress. At the same time, we are seeing actual price declines in other once-booming markets: Jacksonville, Florida, Dallas, Texas, Atlanta, Georgia. When prices fall where people bought with low down payments, they can go underwater fast. This divergence makes for a complex, dangerous environment. An investor might look at Cleveland or Newark, prices still rising, and think everything is fine. But that strength can be misleading. It can mask rot developing elsewhere. Crises rarely happen everywhere at once. They start in the weakest links. It begins in a Laredo or a Jacksonville. Then it spreads through fear, through losses at banks with regional exposure, and through a general tightening of credit. Watching these regional hotspots isn't academic. It's a critical part of risk management. The stress we are seeing in the housing market is not happening in a vacuum. You have to look at the entire financial picture for the American household, and that picture is looking increasingly strained. Total household debt continues to climb, reaching a staggering $18.8 trillion at the end of 2025. That's not just mortgages. That includes auto loans, credit card debt, student loans. When a family is juggling multiple large debts, their budget has zero room for error. They are walking a financial tightrope without a safety net. We are seeing clear signs of trouble in these other areas. Credit card debt has soared, recently hitting $1.28 trillion. More importantly, delinquencies on those credit cards are rising, especially among younger borrowers and those with lower incomes. Auto loan delinquencies are also ticking up. This matters immensely. For most families, the mortgage is the last bill they will stop paying. If they are already falling behind on their credit card or car payment, it's a strong indication that they are in serious financial trouble. The mortgage payment is often the next to go. This multi-layered debt burden creates a cascading effect. A job loss, a medical emergency, a major car repair can be the trigger that causes the whole house of cards to collapse. A family that might have been able to handle their mortgage on its own can be pushed over the edge by a spike in their credit card interest rate or a stubbornly high car payment. The New York Fed noted this exact issue, stating that the deterioration in mortgage delinquencies is concentrated in lower-income areas and in areas with falling home prices. It's the perfect storm of high debt, low income, declining asset values. This is why you cannot just analyze the housing market in isolation. You have to be a student of the entire consumer credit landscape. The rising stress and other forms of debt is a powerful confirmation of the warning signs we see in the mortgage data. It tells us that the problem is systemic to household balance sheets, not just specific to housing. It means the consumer is getting weaker, and since the consumer is the engine of the U.S. economy, a weaker consumer means a weaker economy, which in turn puts even more pressure on the housing market. It's a dangerous feedback loop. So, the signals are flashing. Risky loans are back. Regulations are weakening. Delinquencies are rising. Regional markets are showing real pain. This is not the time to panic and sell everything. Panic is not a strategy. Smart, disciplined, prepared. The easy money has been made. Protect your capital and find opportunities in the dislocation. You need a clear-eyed action plan. Here are 3 practical steps every investor should be taking right now. First, underwrite everything as if a storm is coming. Buying a rental property? Magnify the details. Buying a mortgage-backed security? Magnify the details. Buying stock in a home builder? Magnify the details. Do not trust rosy projections. Assume stress. Assume home prices could fall 10% locally. Assume the borrower's income could decline. Look at whether the asset can generate cash flow in a tougher environment. If a deal only works in a perfect world, it's a bad deal. Conservative underwriting is your best defense. Second, price risk for reality, not hope. The market isn't paying you enough for certain risks. If lending or buying debt, demand compensation for higher default probability. Be skeptical of low yields. Dig into the collateral. What percentage are ARMs? What's the FICO score distribution? What's the geographic concentration? Avoid securities heavily exposed to regional hotspots. If you can't get paid for the risk, walk away. There will be better opportunities later. Third, invest with discipline. Have rules and stick to them. Know your entry points. Know your exit points. Don't get caught up in fear. Don't get caught up in greed. Stress test your portfolio. Understand how much you could lose in a worst-case scenario. Make sure you can live with that loss. These signals aren't a guarantee of a crash, but they are a powerful warning the odds have shifted. The market is telling us to be careful. Listen. Be patient. Build a watch list of quality assets you'd love to own at a cheaper price. In a market on edge, cash is not trash. It's a weapon. Be ready to use it. Invest with discipline. Underwrite conservatively. Price risk for reality, not hope. Because when delinquencies climb and price signals distort, payoff comes not from optimism, but from clarity on fundamentals.